when you're underwater, people stop doing maintenance. Right now, right, you were not dealing with this crazy like floating rate debt situation where literally all the money that's being generated by these properties is being sucked into debt service because, yeah, they had rate caps, but everybody to buy a rate cap to lock you in where you were was too expensive. So nobody did it. So they were like, yeah, I don't think rates are going to go up by more than 3%. And they never really thought like, well, what happens if they do go up and hit the rate cap? Right. No, I don't think anybody was making that calculation.
Alrighty, folks, we're going to talk about what the Fed did yesterday. More importantly, what the Fed signaled in the dot plot. We're going to talk about Jerome Powell's press conference because I think it was actually very different than the dot plot. And in part two, we're going to talk about extend and pretend. Can extend and pretend actually save the multifamily market? We'll see. Jonathan, how you doing, buddy?
I'm doing great. Welcome back.
Thank you. I appreciate it. I love talking to all my friends each and every week. So I really missed our conversations. So thank you for that. So it's good to be home. Good to get away. Good to be home. But let's talk about Fed Day. What was your takeaway? What was your, was there anything market moving? Any thoughts? What'd you see?
Yeah, I mean, nothing happened and nothing was kind of what everybody expected. So, yeah. Here we are. I know that they were, talking about the dot plot, that there's 2 cuts sort of foreseen. But the interesting thing about that I was reading is that, yeah, that hasn't changed except the number of Fed governors who said there'd be 2 cuts declined, right? Yes. So it went down from like 15 to 11. So yeah, there's still a majority saying that there's going to be 2 cuts, but now there's a lot less certainty around it. So I know that like the economy is just sending like crazy mixed signals right now, which you often see like before recession hits, right? I mean, you kind of see like a lot of just garbled, jumbled data, and it's kind of hard to get a read. So maybe there is a recession coming, but we just don't really know how that's going to play out. I certainly don't, and how it's going to affect the Fed, because I mean, look, people have been talking about stagflation for a while, right? And it's kind of like the interesting thing is that like I've seen the stagflation chatter really diminish since Trump came into office, because I think most of the people who were talking about stagflation were Republicans. And now they're not talking about it anymore, because I don't know if you've seen all that data about like how the perception of the economy has like basically flipped. Like when Biden was in office, all the Republicans thought it was terrible and the Democrats thought it was good. And now that Trump is in office, the Democrats think it's terrible, and the Republicans think it's good. So like the stagflation chatter, which is mostly, I think, kind of like something that Republicans were more inclined to talk about, like you don't see Democrats taking that up now. So it's sort of like disappeared from the discussion. Yeah. But I think it's still, I don't think it's any less relevant now.
No, I would tell you my biggest takeaway looking at the dot plot was stagflation is more likely than not at this point. Because what did the Fed do? Right? They're 18 votes plus Powell 19. They took down GDP. They raised inflation. And they raised the unemployment rate.
Yeah.
Right. So that's when you step back and say those things.
Yeah. It looks like a recession. I mean, like it's going in different directions. Right. And we haven't seen this. I mean, God hopes we avoid it. But we're going to find out what the Fed really cares about. If we go into an environment where PCE core inflation, let's say, goes back to 3 or 3.1, GDP goes from, I don't know, whatever it is, 2.8 to 1, right? Still positive, but below trend. And unemployment goes to, I don't know, 5.5%. My bet is the Fed cuts, but we'll see. I mean, yeah, that's it's interesting, right? I agree. I think that they would probably sacrifice inflation as long as it doesn't get.
Yeah, it doesn't go to 9.
Yeah, but I think if you start seeing, I mean, they'll probably be okay with, if they cut and inflation stays like 3-ish, 3.5, like they'll probably just grit their teeth and bear it. But if it starts ticking up over like 4, and the trend line is looking bad, I mean, then
Yeah.
I think there's a good chance that they're going to start, turning the screws a little bit. And then, they've got a really difficult job to do, because it's like, okay, turn the screws, unemployment goes up, loosen the screws, inflation goes up. And then, how do we, I think it's going to take some serious medicine to get out of that, again, it's like Paul Volcker time again.
Volcker time. I mean,
Yeah.
at some point you're like, you got to kill this thing. I mean, we really could end up there, and that won't be quick. That would probably be a 2026 thing.
Yeah.
Because again, people always assume that these things happen faster than they do.
I mean, look at the 70s. The 70s was like a slow motion train wreck, right? I mean,
correct.
It just was like high. I know you have. I mean, you're the guy who's looked at this stuff.
Yeah.
That we definitely. I mean, the 1970s was the era of the flat stock market. It was the lost decade in stocks.
Yep.
You had like high inflation that people complained about, and high interest rates, but they didn't jack them high enough to stop it until Volcker came on. So the whole thing just sort of happened. Everyone was trying to hoping for the best, but without taking action to make it change. And
that's been my big fear for several years, is we're going to repeat 1978 to 81, 82. I mean, I was just old enough to remember how terrible that economy was.
But even before that, I mean, really before 78, because I forget how old you are, but
53.
53. Okay, so I'm a little bit older than you. So I mean, I remember the first gas crisis in 73, waiting online, waiting with my parents online in the car.
Yeah, they did odd and even numbers.
Yeah, they did it again later, right? The second time, in 78, 79.
That's the one I remember.
Yeah, but the first one, I remember being very little and waiting online for gas. And I mean, I don't think. Well, who knows? We produce a lot of gas, so I don't think that's going to happen.
It's not going to be.
It won't be gas this time, but I mean,
Yeah.
Are we going to have $11 eggs?
Yeah. Well, let's talk about because again, I think there was a lot of stuff buried in Powell's presser.
Yeah.
That are interesting. The first one that I actually broke out laughing. I laughed out loud when I read this. Powell said, tariff inflation is transitory.
Yes.
I was like, dude, pick a different word. What are you doing?
The T word. Yes.
What are you doing? You don't want that as your bookends in the story of Jerome Powell being Fed president. You freaking should have picked a different word.
But let's just think about this a little bit though, because I mean, when he's saying that, what is he getting at? And I don't know. I'm just riffing here because I don't know. Yeah. But is he saying that he believes that when the dust settles, it'll kind of be like last time with all the tariff talk that kind of didn't really go anywhere in the end? Or is he saying that tariffs are coming, but the economy it'll be a one-time adjustment, and then the economy will then there'll be a new equilibrium and inflation will go down. Now that's different from saying that prices will go up and they'll stay there, right? It's not like they'll come back down, but inflation is the way it's measured, because it's measured on what happened yesterday, right? So it's that by that measure, inflation will slow down again because the acceleration in costs will slow down. But once you've had the jump, just like we had during COVID, prices don't go back unless you have a major recession, right? But they don't really tend to. You got to have deflation, right? Which we're not allowed to have, right? So
apparently we're not allowed to. Yeah. No, I just let's answer the question. So I think you're right. I think what he's saying is any inflation is a one-time event from tariffs. But let's also say this. It's very clear that President Trump, should he do what he is saying, it will be tariff after tariff after tariff, right? Because again, I do this, they do that. I do this, they do that.
Yeah, it's classic trade war, right? It's just a test of wills, right?
Yeah, not good. So but I think it is the whole one-time thing. But the other thing that I think is actually more interesting, because I just think it was comical that he used the same that transitory. I just think it's like, dude, you're a smart guy. You should have picked a different word. Is he said, and I actually wrote it down over here. Basically what he's saying, I can't find it. Oh, Powell says tariffs tend to bring growth down and inflation up.
Mm.
Right. And then you have President Trump coming out hours later saying the Fed should cut rates to ease the economy's transition to his tariff plan or regime. So we're starting to see Powell and Trump really duke it out. I think Powell sent a message to Trump saying, "Hey, tariffs slow the economy, raise prices. You're holding me back." And Trump saying, "Hey, lower rates, help me out." This battle, I think, is really starting to heat up.
Yeah, and I think what's potentially an issue here is if the Fed's independence is eroded, right, and it becomes, the Fed does what the president wants. Well, every president's going to want low interest rates all the time until the inflation genie, gets out of the bottle, and then, gosh, who knows what happens, right? So we really need an independent Fed. But we'll see where this is going.
The last thing we'll talk about with Powell that I took away was the sentiment has fallen pretty sharply, but economic activity has not yet. Basically saying that, and again, it's really funny. We got we got existing home sales at 7 o'clock this morning, and they too surprised to the upside, like by a mile, right? They were expected to be 3.95, came in at 4.26. Consumers do this. They've done this historically. They talk one way, but they actually do something completely different. And I think existing home sales is a great example of that. You have a lot of people being nervous and concerned and yada, 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 but they still signed up for the biggest, purchase of their life. And they did a lot more than was expected.
Yeah, well, I just know anecdotally, because I'm about to sell my dad's house, that we talked with the brokers and they were like, this market's on fire. Yeah. So
wild.
Yeah. So, I mean, and this is not like Florida or something, by the way. This is like, like suburban New York. And they were like, this market is on fire. So, you're right. It's what people, and, it's always a question of too, like who's getting polled, who are they asking? Where does this data come from? I think people do tend to, and like we were just talking about before, like if the sentiment about the economy has like for Democrats has dropped off the table, like that would impact how that data looks, right? Where if it, so like, because I think what I was reading is that like Republicans, so they're bullish on the economy, but they're not as bullish as Democrats have become bearish, right? So that's pulling down the averages, right? But then people are just going and acting like rationally in a market, like
that's the magic. I think a lot of this polling data, this is what I think. I think the fact that the polling data could be fairly well estimated based on the fact if you call yourself blue or red makes the data irrelevant. It just does. I hate Trump, thus I think everything sucks. I love Trump, thus I think everything is great. That is BS. No human being really acts that way in real life. Most of us will not make a purchase decision because who is in the White House.
Yes.
Well, and this is because of our family, our household, our local environment.
And we had the same discussion before the election, remember?
We did. Absolutely.
We had the same exact discussion where people were like, oh, I can't make a decision about X until I know how the election comes out. As if that were somehow going to make a difference. If Biden is reelected, I'm not making another investment for 4 years. We know that was BS because the market went nuts when Biden was president. The real estate market went nuts. It had nothing to do with Biden, right? And similarly, when Trump was in office, the real estate market was strong. It had nothing to do with Trump, right? It's like these. But I think when people ask them a general question about sentiment, which is essentially how are you feeling right now, right? Then that reflects like all of the things that go into how you're feeling.
That's the boogeyman in the White House. That's all it is. I mean, I did a video yesterday, and I kid you not, I had at least 10 people call me a Trump lover, and I had 10 people call me a Trump hater, which means I was in the middle. right?
Which means you're doing it right?
Yeah, exactly. I was doing it okay.
If you piss off everybody, you know you've done it. You know you're doing a good job, right?
Yeah, but I mean, if you're so biased that all you see is red or all you see is blue in everything, that's on you, buddy. Because that's not how life works. It was wild to watch. So let's talk about one more thing, and we'll get to extend and pretend and multifamily. Where has anything changed in your opinion on what the Fed will actually do with rate cuts? Do you see them doing 2 rate cuts? Do you see them doing more or less? What are your just wild ass guesses?
No, I mean, I've always been a bit skeptical of this 2 rate cut scenario, just as I was with the rate cuts that people were predicting in the last few years. I think that the data is just too muddled. The economy remains, and you can say like, okay, yeah, like, I mean, if someone was posting today about how they're projecting unemployment to go up by it'll effectively be 100 basis points from from peak employment. That means recession. We've never had a recession. We've never moved that much, except but 4.5% or 4.4% is still below what you and I learned as full employment. Yeah. Right?
Dude, when I started college, it was 6%. When I got my MBA, it was 5%.
Yeah.
But yeah, 4.5, 4.8 below full employment, guys. Come on.
Yeah. So I mean, so the idea, well, yeah, you could, it's just like it just reminds me of the whole Claudia Sam discussion that we had last year, right? Yeah. Like where everyone's invoking the Sam rule, and then she's like, yeah, but like, it doesn't apply. Amazing. It doesn't apply when like the economy is superheated already. And I'm not sure I would call the economy like superheated right now, but it's certainly not like,
but when like when we look back and we baseline it and we had whatever it was, 3.8 or 3.9, whatever the low watermark was. Yeah. And I've actually had Claudia Salm on the channel a couple of times. She's wonderful. But yes, we talked about that first episode is like, yeah, Michael, the Salm rule is broken.
Yeah.
The Psalm, I mean, she set it up. I mean, this is the thing that she's known for. And she's like, guys, stop looking at it. It's not working in this environment.
And the funny thing is how, I mean, and this just goes back to your political bias point, which is like Claudia Sam says the Psalm rule is broken. And yet there are all these people out there saying, look at the Psalm rule. It proves my point.
It's been perfect. It's never missed.
Yeah. It proves my point, that we're going into a recession because I don't like the guy in the White House right now. And I mean, listen,
to be clear, the guy in the White House at that time was Biden.
That's what I'm saying. Clear. Yeah. That's what I'm saying. Yeah. Yeah. So, but I think that, I mean, maybe we should do a whole sort of episode about this sometime, but like the issue of like cognitive bias in investing is something people really need to understand, because there's a huge amount of bad decision-making that happens based on like factors that have nothing to do with the investment that you're contemplating, right? Whether it's a presidential election, whether it just, you have to make decisions based on the data in front of you, not like what other people are telling you, what you want to believe. And I think this is an important topic that we should give its own segment to in the next few weeks. Yeah.
Let's note that down, and we'll make that next week's topic. But let's move into extend and pretend. We have both felt, we've actually done the math for the audience years ago, how $100 million building could be worth $48 million. We've seen that and more transpire in office and in some multifamily. But this extended pretend thing has been going on, I'll call it 2 years, maybe 2.5. It's still going on. I think there's over $1 trillion in stuff coming due this year. Could they really push it again?
I mean, sure, they can. I think lenders will push it if they think that there's value in pushing it. Right now, so this topic came up because you said that you had spoken to an investor who was like, "Well, where's the crash? I haven't seen it yet. Where's the crash?" I mean, the first response to that is actually there already has been a crash.
Yeah.
If you see where apartments are trading right now, they are trading at about 25% less than they were at the peak.
The key is the word trading. That's the key word.
The problem, though, is that the trading volume is very thin, right? Because
skewed to the top end.
Right. So what is trading right now is like the best assets out there.
The cherry, the tippity top, class A, triple A, whatever you want to call it.
Yeah. Or like really solid B properties, right? That have actually gone through their whole value add process, and they have grown their NOI, and they have they're like basically solid operations. Those deals are trading. What's also happening at the same time is a lot of deals are coming to market and they're not trading.
Correct.
Because no buyer can get to the price that the seller is requiring.
Right? That's the big thing, is the gap. I call it wish pricing in residential.
Yes.
I guess I could use that in commercial as well. But it's basically a seller that has to sell at some number.
Yes.
To give them a clean exit. But
yes.
That's not but the buyers can't make that work.
Exactly. Because of not just because, and as we've discussed, it isn't, everyone is focused on interest rates, but it isn't just interest rates. It's interest rates and expenses and higher vacancy in a lot of markets. Right.
Yeah.
And so interest rates are not going to save these deals. Right. So we're right now. So this is 2025. The peak was like 2022. Right. We're kind of in exactly the same place in the market cycle that was existing when I got into this business in 2011, right?
Okay,
and
so tell us about that. Yep.
So in 2011, about 3 years after the peak of the market in multifamily, and there wasn't a bubble in multifamily, right? There was a bubble in single family. There's no bubble in multifamily, but we're still 3 years past the peak.
Yep.
I spent 2 years like trying to find a deal that would work. And the reason I couldn't was because the sellers' prices were unrealistic. We could not get there math-wise. And it took until 2013 for the market to actually bottom out. And that was because 2013 was 5 years after 2008, when all the 2008 vintage deals had to refinance, right? And that stuff started coming to market no matter what. Like there just was no longer any chance to, and the banks were not letting people extend and pretend. They were just like, it's going to market or we're foreclosing, and that's it. So that's when the market bottomed out. It took a long time because people, they don't sell unless they're forced to sell. Right. There's some like testing of the market, like hoping that they can get out, right? But it wasn't happening, and then they held on as best they could until 2013 when they had no choice anymore. And I think what is going to happen is the same thing, or we're seeing the same thing right now. But the difference is that there was a record transaction volume in 2021, 2022, plus a record refinancing volume, which people often
ding. It's not only the purchases, it's the refis. Yes.
There's the refis. All that is coming due, right? Yes. And the plain math of it is that there just isn't enough money around to refinance all that, and certainly not at the prices that those sellers need to get their equity out, right?
Yeah.
So
it just seems like I love that you brought up the timeline, because I think we are repeating that, and it's the fact. Oh, hey puppy.
Yeah, she sees something out there. I don't know what it is, but
it's okay. It's all right. So yeah, it's going to be interesting watching to see when this unlocks, because again, Class A is trading 25% discounts roughly. Class B and Class C for the most part are not. But again, the discounts that are going to have to go to make that make sense is going to be 40 or 50%. It's just, it has to come.
Yeah. I mean, last time the peak to trough for multifamily was about 33 to 35%. I can't remember exactly, but it was definitely in the 30s. And that, as again, I'll repeat, there was no bubble in multifamily.
Right.
It
didn't expand, right? So you didn't get that extra.
Yeah, you didn't get the extra overpayment and all the refinancings at these crazy valuations, right? That we had. I mean, we had record low cap rates at the peak of the market in multifamily, right? And so that is going to come back to roost. And I just think that it has to. So the fact that it hasn't happened yet, and I keep on seeing people say this all the time. Well, it hasn't happened, so therefore it won't happen. It's just like when I was predicting the crash, and people were like, "Well, it hasn't happened, so therefore it won't happen." It's like yes, it's going to happen. Maybe you and I are not exactly right on the timing, but we're sitting here watching, we can see this battleship with a full head of steam, right? And a broken rudder, like, and the engine, and you can't cut the engine off, right?
Yeah.
And it's
coming.
just coming. Yeah. And even if you cut the engine off, like that boat just keeps going, right? Because you don't have brakes on a boat, right? So it's like this is going to happen, and get ready, folks, because there's going to be some great buying opportunities, right? So
yeah, I mean, just think about the operators, right? Because again, some people watching this haven't been through this. You and I saw it. I mean, I tell people all the time about that 18 unit building, 1.4. Why was it 1.4? Because that's what they paid for it years before. Then they stopped doing maintenance, and the bank gave them an extension. The bank gave them another one. Eventually, the bank goes to the building and realizes it's a complete disaster. Then they foreclose, and they have to eat a $700,000 loss.
But listen to this. I mean, so yeah, that scenario, like you've said, like, when you're underwater, people stop doing maintenance. Right now, right, you were not dealing with this crazy like floating rate debt situation where literally all the money that's being generated by these properties is being sucked into debt service because, they had rate caps, but everybody to buy a rate cap to lock you in where you were was too expensive. So nobody did it. So they were like, I don't think rates are going to go up by more than 3%. And they never really thought like, well, what happens if they do go up and hit the rate cap, right? No, I don't think anybody was making that calculation. And because even the debt brokers were saying, oh, interest rates are not going to go up, right? So basically all the money there's nothing for maintenance. There's nothing of it. It's not even a decision of like, we choose not to spend it on maintenance because we're underwater.
Nothing left.
There's nothing there. So a lot of these properties are going to just continue to deteriorate, and it's going to be like, heaven for true value add, folks who can really go in and like fix a distressed property. There's going to be a lot of opportunity for that, but a lot of people are going to get their heads handed to them.
Yeah. And again, I think what we're really saying is you and I think we can admit we were probably early. We thought, frankly, I thought it would be here already, at least on the edges. I haven't seen anything. Because again, I don't play in Class A in all fairness. But it's maybe it's 26, maybe it's 27, but at some point heads are going to roll. It just has to.
Yeah, I think the 5-year debt term is a big one, right? Because either you had 5-year debt, or you had 3 1 right?
Yeah.
And whether the banks want to go beyond that 5-year period, at some point they've got to get these loans off their balance sheets if they're not performing. At some point, they just want to recycle the capital into something else. They don't want to administer these things anymore with special servicing. Like it's just time to move on, right? They've got to clean up their mess, and you'll just start seeing forced sales, short sales, and outright foreclosures.
Yeah, I think it's coming. Again, it may push all the way to 26, but there's even slightly lower rates are not going to save these folks. We're not going that low.
Yeah, it just when people were, if you think about where they were buying these properties at, some deals in Texas were trading at sub 4 caps, right, and which meant that the debt had to be in the 2s.
Had to be, yeah.
And so you're just not going to get to sub 4 caps, right? It's just not going to happen, especially in markets that are oversupplied. Like nobody's going to pay a 4 cap in a market where rents have declined by 20% in the last couple of years, right? It's just not going to happen. They have to account for that risk, that oversupply risk, right? So it's just not happening. And even if they do, let's say, even if they do pay a 4 cap, it's on reduced income anyway.
Yeah, it's going to say the NOI is lower,
right? Because taxes have gone up, insurance has gone up, like labor costs have gone up. Everything has gone up by 20% at least, right? So it's like so if you do get that 4 cap, you're still looking at a lower valuation because the NOI is lower.
Yeah. So at the end of the day, I think extended pretend, frankly, has saved more people than I thought it would through today. I don't think it'll go forever. I think a lot of people have clocks on this money. I think you're right. I think there was a lot of 3 1-and-1s, and people are now in the 1-and-1 period. So, maybe that bottom 18 months, but when you do a bad deal and when you do some really, really bad deals, you're going to get got, and it's coming.
So I just want to say, I'm proud to say that I'm a partner in a deal, but I take no credit for this because this is all due to Omar Khan, my operating partner. He's the lead sponsor. 100% credit due to him, 0 to me. But I'm part of a deal which is the only deal a bank has seen in the last couple of years that refinanced for a cash out refi in 2025.
Really?
Only one. So Omar's done an amazing job with that property, steering it through floating rate debt and all these other things to get a cash out refi.
Was it a multifamily or what?
Multifamily, deep value add multifamily deal.
What state? What state?
Georgia.
Okay. Well, congratulations to him, Omar. Nice work.
So,
yeah, it's going to be really interesting because, again, I think what really this boils down to me is we just got to go back to kind of the record period, 2022. We had a lot of what I've often called pretenders.
Yeah.
Right. They came in because it was hot. The math was easy to understand. They had access to money because of their friends. And they probably felt like winners for a year and a half. And then the real work came and they don't know what they're doing. There's just a lot of fake operators out there.
I mean, listen, there are some groups out there who came out of nowhere, and I don't know where this money came from, but they were like buying booths at every conference for a couple of years, raised, a ton of investor money, right? And did a lot of splashy deals. And those guys, like the girl talk around the water cooler is, not good.
Yeah.
And they continue to raise money even today, which is kind of incredible. But there's a lot of operators like that sort of appeared on the scene, like in 2020. They literally came in at the top, and then the market went crazy for 2 years. So they made some really good returns by flipping in the first couple of years because they just got in at the right time, got in and got out at the right time. But a lot of those deals are now like sucking wind on the other side that they didn't flip. And there's going to be some bad things happening.
Yeah, totally agree. Well, Jonathan, you're doing a lot of amazing stuff. Where can people follow you?
Well, you can come to my school group if you would like to learn more about multifamily, or you can come to me directly on LinkedIn. I really encourage people to sign up, just connect with me on LinkedIn, follow me there, talk with me there. It's a great community, and it's where I share a lot of my thoughts.
Folks, let me know if you reach out to him on LinkedIn. Just send him a note, say you heard him on One Rental at a Time. It'd be great. Thank you.
Awesome. Thank you.